All right. Hello. Oh, I got to turn my volume up.
All
On
right,
here.
fix my audio now.
There we go. All right. Can you hear me?
Yeah, can you hear me now?
I can. So
Okay.
I got a fancy new microphone. Look at this thing.
Oh, that's official. That's a real podcast microphone. That's pretty cool.
I know. I feel like Howard Stern.
Yeah, yeah. There you go.
And I've normally I was using my laptop, so now I'm actually using my desktop. I got a camera right in the middle, but it makes. I'm gonna move the screen off to the side here a little bit so I won't be looking straight at you, unfortunately.
Yeah, no, it's an adjustment.
Well, just when we thought normalcy was here, we're back to the normal that we know. We got a limit move.
Yeah, I mean, it's pretty insane in that we had the limit up move on Friday with really nothing going on. You had the sharply higher open yesterday morning, and within an hour and 5 minutes, I think the market had a $117 trading range, a massive outside reversal day yesterday, and kind of now you're getting the follow through. Once we broke down through the lows from last week, unfortunately, yesterday was your bull trap to the upside, and then today's resulting, just beating the longs that probably chased the strength the last couple of days.
Yeah, that move yesterday was that was a powerful move. I mean that.
Yeah, off a relatively light volume, and that's a little disconcerting when you get those kind of moves without the volume to support it. There's just unfortunately there was a lot of fluff in chasing the momentum.
Yeah, I mean I like to refer to that move as that's a trader's move, and by that what I mean is it takes the true mentality of a trader to say whatever I saw, like the bull side. If I was buying it, whatever I saw didn't matter. They were coming back to sell it hard.
Yeah, no, I agree. I agree, and unfortunately, I think whatever attempt for cash to kind of stabilize and see some trading, I think there was some hope on Friday and then some spillover into yesterday morning. Once those gains got evaporated and we were down, it just kind of took the wind out of cash sales, at least for the time being. And you could make the case that with yesterday's move, we got up into that 990 area from the low end of what I've heard in cash. You can make the case that you had, for one fleeting moment, brief moment, you had convergence between cash and futures before futures decided to crap out here.
Weren't we just talking about how big the basis was?
Yeah. Well, it's still, according to where print is and where some of the mills' ask prices are today, you still have this massive basis.
All right. Well, we got a lot to talk about today.
Yeah. I got a ton of slides, so we'll run through this.
Oh,
This is going to be more economics, the economy, and then we'll kind of jump into lumber. But I know you saw this. Let me jump here. Okay. So I know we had both seen this on LinkedIn
I think
over the
it was
weekend.
on Bloomberg, wasn't it?
It might have been on Bloomberg. I saw
Yeah.
it on LinkedIn from Ed Yardini Research, and Dr. Ed is on Bloomberg and CNBC. He's a regular contributor on both. He puts out some phenomenal economic research, but this is all S&P sectors and industries year to date, and this is as of April 8th, or I'm sorry, April 6th. I can't even see my screen. Uh, the obvious, you look at what's up the hardest here. It's oil, fertilizer, agricultural, steel, healthcare. You've got this massive explosion to the upside. Here's your inflation. And then, unfortunately, you look at the bottom of the list, and literally the bottom of the list. This is your bottom 10 or so, and bringing up the absolute rear here is home building, home furnishings, household appliances.
Just to make sure it's clear, This is the performance of these stocks, these publicly traded companies that are in these sectors.
Correct.
For year to date. So since January 1st to today.
Yeah, this is January 1st, and the S&P just categorizes individual stocks into these sectors. So home building, obviously, there's your home builders. Household appliances, well, that's what goes into your home. Home
So
improvement,
let's
retail,
let's take
Depot,
a
Lowe's.
second. Let's take a second and say, put ourselves in the mind of the stock traders who, all of a sudden, at some point between January 1st and today, they said, I own home builder stocks. Something's happening in the economy that I don't like this. I want to exit home building stocks.
Yeah.
I want to exit home furnishings, auto parts and equipment. That one kind of fascinates me. But then you start to look at some of these other ones. It's discretionary spending, personal products and movies and entertainment.
Yeah, footwear. I mean, a lot of this stuff, obviously, define discretionary versus a necessity, a core good. And when you look at the leaders of the pack up here, a lot of this stuff is core. It's a necessity. It's not a luxury. And again, home furnishings. The auto parts. That's kind of a weird one. Personal products, movies, entertainment, household appliances. What's discretionary versus, what's necessity versus luxury.
But
Yeah,
let me play
yeah.
the devil's advocate here just a second, though. Are these coming off of par levels, or are they coming off of way inflated levels?
Sure. And I think
So
the
look,
answer, yeah, and I think that's a great point.
car prices were massive. Used cars were so expensive. You look at the old jalopy out in front in the driveway, you're like, you know what? I am going to put new shocks on that. So now all of a sudden, I just heard used car prices are crashing. So people aren't going to fix their stuff up, right?
Yeah. No, I think those are great points. And the reality is, when you're at all-time highs in a lot of these sectors, well, the second you downtick, you only have really one direction to go when you reverse, and you get these hard reversion to the mean, or just hard, corrections. But this is kind of graphically, this blue line here is the S&P year to date, so it's down around 7.32%. The purple line is Lowe's. So you can see Lowe's is down about 19.84%. I don't know what happened to Home Depot's should be. Here's Home Depot down 24%. And then
Wait, you didn't make Home Depot an orange line?
I ran out of time to think that far out ahead. Yeah. That's good. I guess Lowe's should have been blue then too. But then the other ones are basically your top. I threw Toll Brothers, but then I also basically just picked up the top 5 home builders. So you've got Pulte, you've got Toll Brothers, D.R. Horton, Lennar, and then Taylor Morrison here. And you can see this is again year to date. They've all taken it to the chin here. But again, I think your point, when you're at all-time highs, and you have this kind of corrective move, at the very least, you just see how you get this sector rotation, and seeking alpha. The money's going to chase the inflation, and you see cash flow coming out of these laggard sectors into these sectors. And at some point, when the market gets the feeling that inflation's under check, or at least it's mitigating, then you'll probably have the reversion and see at some point these industries that are getting beaten up here kind of be the leaders of the pack again. And so, so what does this all mean? Well, I think, the other headline number that came out today is CPI, and CPI had its largest increase since 1981. So here's inflation expectations 1 year versus 3 years ahead. And 1 year ahead, you look where you were at a year ago. The Fed, basically our forecast, we're underperforming. Inflation is around 2.5% to 3%, and you had this explosion of inflation, and so the bottom line is Well, inflation. This is CPI as of this morning, 8.5%. Look at the surge in fuel oil, gasoline, used cars and trucks. And again, this is an annual change. Airline fare, natural gas, new vehicles, food. A lot of this stuff, I guess, could be considered discretionary versus a necessity. But the point is, inflation is surging higher, so people have, and so I want to get into two other points here. So here's consumer credit outstanding, consumer credit and personal savings. You can see how consumer credit, okay, people stopped spending during the start of the pandemic, and now you're basically in this uptrending pattern of people using more credit. And then you can see that uptick consumer credit outstanding. You're not too far from your mean type pricing, but look at savings. Savings spiked as people stop spending, as the economy kind of opened back up. You can see that personal savings is starting to plummet back down to reality. And then this is further evident. I'm going to come back to, this is where I'm leading with all this. Here's your nominal wage growth versus inflation. And so you can see wage growth is somewhere between 5.6 to 6.8. And you've got inflation, realistically, okay, inflation came out at 8.5%. Now, this is an average, like core inflation, services, goods, food, energy. The point being is that wages are not keeping pace with inflation, whether you're talking core goods, discretionary goods. The average person's wages are lagging woefully behind the cost of inflation, the cost of goods. I mean,
The
that's
reality
the
is
bottom line.
it's more expensive to be alive today.
Yeah, absolutely. Absolutely.
And that I think an underlooked segment is the retired population, or the fixed income population. When things become more expensive for them, their consumption level, apparent consumption, goes down because they're spending more on the staying alive, basically.
Yeah. So I think the other part of this is, and that's a great point. And there was a chart I forgot to put it in here, but when you look at, okay, the S&P is down 7.32% for the year to date. Obviously, NASDAQ's probably a little bit further down, Dow's in somewhere in between, but you don't have the cash cow of equities just continuously making double-digit returns here. Okay, if your wage growth has stagnated, not keeping pace with inflation, well, obviously that impacts. You're going to see credit card usage increase, and bear in mind, your monthly payment's going to go up with interest rates moving higher, and you're going to see savings start to come down. And so this is reflected in the wage, and so this kind of segue into interest rates here. High water.
Hang on, before we jump,
Yep.
I have a very unscientific ancillary antidote to wages. We need to hire another person here to help out with our logistics team. I put an ad on Craigslist, and it's going to pay around $50,000 a year. The number of applicants we had, high quality applicants through Craigslist, was remarkable. Like, I was really concerned about actually, hiring someone. And what I really found interesting was the number of people that applied that just had been out of the workforce for like the last, say, 8 months or, maybe a year. And I think there were a bunch of people just coasting. So I really think there's going to be pressure on wage growth because people are going to re-enter the workforce. Because they need to. They can't live off of, the government payments have all but dried up. So they're running out of cash. They're going to need to start working again.
Yeah, and I think, going back to this inflation read, when you look at, the massive spike, you had negative CPI, and then you have this massive increase. So when you take, valley to peak here, you're almost talking a 10% increase. Yeah, that fixed income, the income that you have that you've been relying on, becomes less and less impactful with the higher cost of goods. So it finally is beginning to push people back into the workforce. And how do you know your fair market value? Go get another job. Go switch jobs. The other part I'll counter here is like, is the average salaried employee. You think about your cost of living increases on an annualized basis when you're a salaried employee. You get a 2.5, 3.5% usual inflation increase in your actual wage above and beyond any performance type incentives. But is the average salaried employee that presently is employed, are they getting a wage increase to keep pace with inflation? The answer is probably no. People that are getting their fair market value probably are changing jobs in the workforce right now.
So Rick Russell, listener, active listener of the show and watcher of the show, is going to be at some Fed meetings, and he's like, "What question should we ask?" And I personally would like to ask the Fed, what do they forecast as far as the employment picture goes? Do they think they're going to see what I experienced, where there'll be more people coming into the workforce? Ironically, I think that would be a deflationary force when we can get more production out of the economy, which we've been suffering from. There's been too many dollars chasing too few goods. If we increase the number of goods going into the market, maybe we can tamp inflation. So, Rick, that's my vote. Is find out what's their impression about what's going to happen with the workforce.
It's funny, Rick brings this up because I'm about to go into interest rates, and there's some stuff in here for the Fed where I think this will be a useful lesson here for ultimately what to ask the Fed outside of the obvious. So your 10-year Treasury surged to 2.78%. 6 weeks ago, this is 1.66%. You can see where you were at a year ago. Literally sub 1%. So you've had this massive increase in interest rates. So this is something everybody keeps talking about, inversion of the yield curve. And the one that always is referenced in the news is 10-year minus 2-year. I like looking at the 10-year versus the 3-month because the 3-month, 6-month, is something more the Fed can control. And as you look at the Fed funds futures, you look at Eurodollar futures, they're kind of leading indicators of where that Fed fund rate should ultimately be. So what this tells you is when you have inversion of yield, short-term rates race ahead to where longer term rates are. So you've got the 3-year, you've got the 3-month, 6-month, you've got the 1-year, 2-year notes racing up to where 10-year treasuries are. So this is the anticipation that I'm taking money out of the far end of the yield curve. I'm putting it into the close end of the yield curve. This is your risk off. I'm gonna realize some kind of return. I want to stay in liquid assets. I'm coming out of equities. I want to be liquid, and I'm going to finally get rewarded to do this with, Fed funds. The target likely to be in this 2.5 to 3%. You're finally incentivizing people to go somewhere else to get some kind of return on their investments. So you can see every time, and I'm going to flip here. Every time you've had this inversion or this negative spread, they forecast recessions. And we had this, going into the pandemic. We kind of glossed over it. This is a pandemic-driven event. It's not indicative of where the real economy is. But if you look at back in 2006, 2007, it was a leading indicator for the recession that took place. Same thing in 2000. This is 1999. You can go back throughout history, and every time you've got this inversion, it's followed pretty scientifically with the recession. And so here's your current Fed fund target. Look at this downward sloping trend. You're basically still half free money at a half a basis point. Where does the Fed belong with their Fed fund target? Well, short-term rates are telling you 2.5 to 3%. So I know I'm jumping all over here, but
Hang on.
here,
If we could bounce back to that last slide.
yep,
Um, now, I think one of the things that I look at this slide, I overlay in my mind the technology revolution that happened starting in the 80s with computers.
sure.
And it's the technology is a deflationary force because it just allows us to do more with less. I mean, it makes us more efficient, right? Um, I agree. I think we are going to see this spike in Fed
Well,
fund
Mike,
rate.
and that's a pretty plausible rationale as to why from 2000 to pretty much 2021, you were running well under Fed target for inflation. And the big argument was technology has made the workforce has made industry more efficient to where you don't need to run at these historical inflation type levels because of technology. I guess my point is, okay, you have inflationary type readings and CPI, PPI, and inflationary type metrics. You're going back to 1980, 85, 1990 type levels. Well, what did the Fed do? What's the Fed's course of action to deal with inflation? How do you slow the economy?
They have
You
this
do it.
big. They have a big sledgehammer. It's
Yeah,
called
yeah.
interest rates.
Yeah. So the point is, every time the Fed has gotten aggressive, and so here is S&P with yield curve inversions highlighted, and so every time you've had that inversion of the yield curve, it's to curb an overheating economy, and the net result is always some kind of corrective move in equities. It's to slow the economy. So look at the divergence here. Look at your yield curve inversion. It usually takes place. You're within striking distance of highs and equities. Look at the divergence here from when it initially happened. We just said it's pandemic related. Look at how far the S&P is above these historical type levels. So like going back to Rick's uh, 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 going back to Rick's question, the Fed is forecasting a soft landing. Like how do can you honestly say that the current inflation is supply constraint driven? And if you normalize the supply chain, that takes a lot of the inflation out of it. That's kind of what the Fed's hoping for here, is that inflation begins to peak as you normalize supply chain, and that they don't have to get overly aggressive and do these continuous half point basis rates to bring, interest rates, the Fed fund rate, to where the short term to intermediate yield curve tells us it should be. I mean, that's kind of the Fed is in a massive, they've backed themselves into a massive corner that they helped create with all this free money. And I get it, but this extension of all this free money has definitely fueled the inflation that they're having to deal with right now.
All right, let's bring it home. What does
Yeah.
this mean for lumber futures?
Yeah. Sorry, went off on a tangent. What does this mean for lumber futures? You're at a major inflection point on the charts. I mean, this 847 area is 62% retracement. This is a weekly continuation. Here's your 100-week. Here's your Bollinger Band low. If the market fails to hold here, it opens up this washout down into the 800 to 770 to 750 area. And when you look at the yield curve, I'm sorry, the futures price curve, well, where are all these other months at right now? They're in that 800 to 750 area. So is this reality of where the market belongs, or is reality, up here? And I think the market is calling out the fact that cash and front month futures are still too high right now.
Absolutely. I look at the July SEP we're compressing right around 750.
I'm going to jump through these basis charts. There's no, the one thing I'll point out, these May Julys, we talked about this. You dropped into that 62%. Market could not get a rally. So you've had the continuance now. We're into the $60 area. So I would look for this spread to move into the $60 to $40 area. At this point, shorts can begin to roll out of May's and into July. Open interest wise, you continue to hang in there. This is last week. This week we're in the 2780, so you continue to build open interest. You're really doing it in the back months, where again, going back to this yield curve. I'm sorry, the futures forward curve. There's comfort in these back months, and
Listen,
that
it's
anything,
a prudent business move. If you've got a project planned and it was based on a cost of $1,500 and you can buy it in right now at $750, like, yeah, it is a prudent move to start securing your lumber needs.
The one thing I'll point out with CFTC, I still don't like the one number that jumps out to me is, and this is kind of, you've got these longs, you've got the commercial shorts. This still makes more sense from a mill standpoint, a production standpoint, from a commercial standpoint. The number that still jumps out to me is this number right here. These non-reportable longs are still pretty heavy. To me, this is, oops, let me jump back here. To me, this is the one to watch, how you could get down to the 800 to 770 to 750 area. If these guys, who's in the pool right now, it's probably a big chunk of this where this has got to get bled out of the market here.
Okay.
Other thing I'll point out, this is all, if anybody wants this, I'll send you the link to the website where we pull this from. Canadian lumber shipments to the U.S. We all hear about the rail situation. When you look at last 3 months, year over year, BC Interior is down around 10.72%. Canada, aggregate Canada as a whole is down about 10%. The one number that jumps out to me is that these are broken down. So this is January of 2022, February, March. January versus January of last year, you're down. February is down dramatically versus February of last year. Okay, we keep hearing about all these rail car issues. Look at the big increase from February to March. There's a pretty big increase to where, you're not that far off of March of last year. And I can't get kind of a good answer from sawmills or really anybody to explain this outside of is that there's more wood being trucked across the border from BC Interior. There's more wood moving across the border than we realize. And so this is, the numbers don't lie, but seeing this big uptick from February to March, given all the rail car issues we keep hearing about, is this contractual wood? Is this wood being trucked instead of rail car moved across the border? But there seems to be an uptick. And if you look at the next 2 months, you should be over 500 here. And then lastly, again, car velocity is starting to improve. Here's shipments from Canada. You're starting to trend now more positively back to where you were the previous 2 years. So again, the question is, to kind of sum all this up on my end, Mike, is where is the risk? And to me, the risk is in ownership of physical cash, unless you can buy at futures type levels. Futures and Southern Yellow Pine present the best value out there. And I would be skeptical of everything else. And I think the industry is skeptical that these numbers are sustainable.
All right, I'm going to go on record and say it right now. Southern Yellow Pine is the bellwether. It's become it's not Canadian spruce anymore. Southern Yellow Pine was the that's the market that corrected the fastest, the quickest. It's the one that went up the quickest. I think you got a chart generally, right? About
I'm going to show you. This is the other thing that jumps out, of interest. So the green line is Southern Yellow Pine. We had issues with COVID. We had issues with getting logs at the Southern Yellow Pine mills. You had the phenomenal Southern Yellow Pine producer on that talked about how they build out log decks. Southern Yellow Pine made new highs this year. This is last year's high. Look at Southern Yellow Pine. Why was it up here? It led the pack to the upside. Now it's converging and leading the charge to the downside. And this makes the most sense because this is where your production comes on. These are the best EBITDAs. Futures is following behind. The other lines, you've got Western SPF, Eastern Great Lakes. You've got Doug fir, hem fir. In a falling market structure, here's your 50% retracement, your 62% retracement, puts you somewhere in this 900 to 700 area. Look at these other species lagging behind. I want to own the cheapest wood. Southern yellow pine and futures is your cheapest wood. I would be extremely critical of buying these other species until you get closer to where futures and southern yellow pine. I'm not going to say you're going to get equilibrium, because you probably won't. You will carry some kind of premium in these other species, but does it deserve to be, with certain mills at 1150 plus in Western SPF? Does the market deserve to be there? Well, right now, futures is telling you absolutely not.
No, and the thing about the markets and futures is we're involved in it every day, day to day, and watching it and interacting with it. And the reality is, taking on positions need to be timed moments in time, right? So we've kind of been sitting here watching that basis spread and saying, look, you shouldn't own cash, you should own futures. Shouldn't own cash, you should own futures. And sure enough, the market forces do what they say they're going to do, and they've basically compressed that basis spread.
Yeah, and then a lot of big questions they get from end users is, well, when do you see spot market prices reflected in my spot market? And typically the lag is 30 to 45 days to see the trickle down effect, to where okay, just because futures is $830 today, the vast majority of the industry is probably still paying well over $1,000, $1,050, $1,100. And so you still have to see that trickle down effect play out to get those actual numbers to reflect where futures are. So again, this is the idea of basis, where I buy the cheapest wood out there. If I'm wrong in buying May at 830, July at 761, then it's going to be less wrong at buying cash at whatever numbers you can buy cash today. You just have to wait for that convergence to play out. And when it comes to that point in time, and I think you're seeing this play out in the field, where the industry is going to buy what they absolutely need and not a stick more, where no one's going to invest. There's nothing investment. You're not talking about investable levels at $1,000. And again, it's just as simple as, where's your risk? Own the cheapest wood out there. And as the cash jobs come due, you release the futures and you go buy the physical cash.
I do want to talk where's the risk as well, though. Over the weekend, I had a chat with a European. This is literally a person in Sweden, discussed the Russian situation. And there is a reality that wood is going to become more expensive in Europe. And there's going to be a higher incentive for the European sawmills to keep that wood domestic. I think what we're experiencing right now is that the sawmills had made a fair chunk of U.S. sized lumber. The U.S., sometimes we get caught in our own little world. Most of the other world doesn't use the size of wood that we use.
Sure.
The only really other places in the world they use that is a little bit in the Middle East and Pakistan. So these mills had to move through that inventory. They've pushed it here to the States. It wouldn't surprise me to see from the 4th of July on a lot less euro available here in the States. And then we'll keep it domestic. Over in Europe. Now, so what does that mean? Well, that means spruce is probably going to continue a premium to southern yellow pine.
Yeah, no, I think the big thing to me is that, I agree, you're going to carry that premium. I think unlike last year, the headwinds facing housing as we move forward are pretty evident, to where there's good business now. There's a big backlog of existing business. I think at some point that new business reaching out forward probably falls off a cliff or becomes a lot less obvious, to where in order to sustain these higher numbers, I think it's going to be much less about demand. It's going to be much more about the supply side. And can you continue to see supply constraints? Do you continue to see logistical issues, shipping issues? To me, it's more supply constraint driven to hold on to these higher numbers than this big resurgence of demand or organic demand going forward.
And just going back to the spruce running a premium consistently, I would give a heads up to people that do forward price, and especially that they are the people buying forward price pine. The Whoever's selling you forward price Southern Yellow Pine is going to try to get par or better with spruce, and it's probably going to run a discount for quite a while. So, just if you're buying forward and you're buying pine, you should look for a discount.
Yeah, I think that's a great point, Mike. I think that's you're spot on in that you don't necessarily have to have convergence with the species here, and that Southern Yellow Pine can float to a lower number because mill returns on Southern Yellow Pine. Obviously, that's the lowest cost of production by design, and when you look at SPF. If I'm looking to pick off deals in SPF, I'm looking for more of the truck-based sawmills. The quicker shipping mills. That's the other thing that's lost on Western sawmills, with order files out until the end of April, first to second week of May. Why am I going to buy your high-priced wood when you can't even ship wood from February and March? I need the wood now. I don't need it. The idea that it's going to ship late. I don't want to buy these overvalued levels relative to everything else when I can't get the existing wood that I've already bought.
Could you scroll back to the continuation chart, front month continuation as well? That back. There you go. One last point I'd like to make, and we probably got to wrap up here. I think the new range that we're looking at here is the bottom, the low from last summer, right here, right there. Yep. And then, I think we put the highs in. It's a massive range. I mean, you're talking like an $800 per thousand range probably in there. The reality is we can move across that. And we just proved yesterday in an hour moving $120 $117 in 1 hour of futures trading. I talked to an active trader who said, there were years where we didn't move $120.
that used to be an annual, but you would be lucky to move in an $80 to $120 range in a year. That was your annual pre-2018. Those are your average price moves on an annualized basis.
So my two recommendations on this is don't get greedy and don't get cheap. Don't get greedy in that, if you really, bet the farm on something, you're taking on a lot of risk. And the other is if you run too lean, you're taking on a lot of risk and you could get forced into the market at a time when you wouldn't want to be in. So there's a good strategy about keeping enough on hand, accepting the new volatility and accepting the swings that you're going to see. But having enough inventory that you have flexibility in timing, without having too much inventory. So you will, suffer too much.
And Mike, I think, so I think that if you see this orangish line, this is your 200 week, it's in the 610 area. I think that this is a pretty good indicator of cost of production for SPF mills, somewhere within $50 of this range. So just remember, even at these elevated levels of, May is $830, even if mills had to take sub 1,000, sub 900 on this move, they're still playing with house money relative to their cost of production. You assume the ownership, all the risk. The mill's transference of their wood at these price levels is still a massive influx of positive cash flow. So just be wary. Where is your risk? And there is risk in ownership here. Sorry, there is risk of ownership here. Is there risk for the mills to sell at this price? No. This is still highly profitable for sawmills to take these counters and just move off volume at these numbers.
So let's just wrap this up. Hey, the one thing is interest rates have moved up. They're not outrageous. The housing market could slow, and it's going to slow from a great level. So this isn't an Armageddon conversation. I think there's so many positives to take out of the market still. So with that, let's wrap this up. We'll check back in next week. And Rick, we expect you to have some great insight from the Fed next week.
Yeah, absolutely. Yeah, that's awesome.
All right, everyone. Take care. Thank you for your continued support of Materials Exchange and of Westline Capital. Shameless plug. How's the signups going for the?
Oh, it's I'm glad you mentioned that. Yeah, it's great. Again, it's April 27th, 28th. I think we have well over 20 people signed up so far. It's a wide mix of sawmills to home builders and everything and anybody in between. So yeah, keep that's still you can still sign up, and it's going to be a good mix of people. So we're excited.
Cool. All right. Great. We'll talk to everybody next week, and be safe.
Thanks,
Have a great
everybody.
weekend.
Thanks, Mike. Take care.
Take care.